How to use moving averages with ICT concepts. This video is for educational purposes only and should not be considered financial advice. As with other retail trading tools we mention on this channel, moving averages can also be used to great effect with ICT concepts. In this video, we will show you some of the ways we are using moving averages to help refine our entries and exits, but also stay in a trend as well. Lastly, moving averages can also help determine your daily bias to decide which area of liquidity price will be reaching for. Stick around until the end of the video, where we will show how we use moving averages to determine the daily bias. The 4-period EMA for entries, exits, and trends. One moving average that really works well for entries, exits, and to stay in a short-term trend is the 4-period EMA with a shift of 4. You can alternatively use the 10-period EMA, but the 4-period is a lot more precise. On the 10-period EMA, you wouldn't add a shift feature. The 4-period follows price closely, but not too close, and allows for retracements that happen during a trend. It also gets you out of a trend shift earlier than the 10 EMA. Here's a look at a few examples of how you could have entered and exited using the 4-period EMA and successfully stayed in a trend using ICT concepts. Here is an example of the difference between the 4-period EMA with a shift of 4 and the 10-period EMA. They're very closely aligned, but as you can see, there are some differences between the precision of your entries and exits. Here they're the same as your entry closes above the 4 and the 10 EMA, but on your exit, the 4-period EMA with a shift of 4, which is in white, this is your exit. Once price closes below the 4-period EMA with a shift of 4, that is your exit. But price did not close until this candle on the 10-period EMA, and that made you lose some of your profit. Here is where we see the ICT entries using the 4-period EMA with a shift of 4. The white moving average is the 4-period EMA. Liquidity was taken, structure was broken, price retraced into an optimal trade entry between the 61 and 71 fib retracement. There was also a fair value gap. Then price closed above the 4-period EMA. This could have been your entry. You could have also entered at the optimal trade entry. Your exit happened once price closed below the 4-period EMA. Here is another example. Liquidity is taken, a fair value gap is created. This could have been your entry, but then you did not have a break of structure. This is when price crosses below this swing low, and that is a break of structure. Now you're looking for an entry, and you can use this order block at 50% of the order block. And you can also feel confident because price has closed below the 4 EMA with a shift of 4. Then price continues down and stays below the 4 EMA. Then it closes above. That will be your exit. The 20-period EMA is great for short-term trends. It can work alongside the 4-period EMA and can really be the deciding factor in whether a trend has changed. Sometimes price will cross the 4-period EMA only to bounce right back over it. By using the 20-period EMA, you can filter out false moves. Here is a look at a few examples on how you could have successfully stayed in a trend using the 20-period EMA. As we see with the 4-period EMA, this is a good entry because it closed below, or you could wait for the retracement back in and you're still below the 4-period EMA. And you can stay in the trend with that 4-period EMA, but this would have taken you out of the 4-period EMA. This candle right here, it closed above the 4-period EMA. However, if you used the 20-period EMA, you would have stayed in the trend all the way down to here. And you still see this is another exit off of the 4-period EMA, where the 20-period EMA still keeps you in the trade. You do not get out of the trade until this candle on the 20-period EMA. Once it closed above, that is your exit. That is a long distance between this candle and this candle. The 50-period EMA can be a great tool to predict short-term reversals. Price will normally react off the 50 EMA even if it's a small move. Since the EMA measures the average of 50 candles, you can look for a move in your direction for at least 20 to 25 candles. Here's a look at a couple of examples on how you could have entered and exited a trade using ICT concepts with the 50 EMA. As we see, price crossed over the 50 EMA, and this is considered a short-term reversal. Price moves upward, and if you count the number of candles since it crossed the 50 EMA, there's 23 bars before it crosses below the 4 EMA, and then there's 35 bars or candles before it closes back below the 50 EMA. Like we stated earlier, between 20 and 25 candles or bars is where you should look to exit your trade. And as we see here at 23, this is the best entry. And we can use the 4-period EMA alongside of the 50-period EMA to help us make that decision. In this example, we can see the ICT concepts work beautifully with the moving averages. Liquidity is our target. Liquidity was taken, and there is a break of structure. Price closes above the 4-period EMA and the 50-period EMA, then retraces after this break of structure back into 50% of this breaker. That is your entry. Price then continues on, stays above the 4-period EMA, does not close below, and this is your exit on this candle. It closed below the 4-period EMA. That move was a total of 42 candles. You should probably be looking at your trade after 20 to 25 candles. But if it stays above the 4-period EMA, you can stay in your trade. The 200 EMA is great for long-term reversals. Since it takes a longer time for price to reach the 200 EMA, you can be sure that there will be some reaction, especially on the higher time frames, when the 200 EMA is reached. Since this moving average measures the average of price over 200 candles, you can look for price to move in a reversal for up to 200 candles. Normally, price will move half that, which is still a great move. Here are some examples on how you could have used the 200 EMA to measure a move after using ICT concepts to enter. As we see price close below the 200 EMA and continued all the way down until it crossed back above the 20 EMA. That would have been your first exit. However, if you were using the number of candles as a gauge for your exit, halfway through is 100 candles. That would be this candle. And you could have exited here, which is basically around the same price. The whole distance between the start of the move and the end, where price closed back above the 200 EMA, was 192 candles. In this example, this is your ICT entry. If we go back to our original diagram, this entry right here happens on the 5-minute right here. Price displaces and liquidity is then taken, and then price closes as a break of structure below this swing low. And then right back up into this order block is your entry. Then price continues down, and you can use the longer term, the 15-minute chart, to gauge your trade. Last but definitely not least is the 500 EMA. You can definitely expect a longer term reversal when price reaches the 500 EMA. Again, this is a measure of price over 500 candles. As a result, price will move at least in a reversal direction for up to 500 candles. Most of the time, it will only move half that. Here are some examples on how you could have entered using ICT concepts after price reached the 500 EMA. First, let's take a look at how price reacts off of the 500 EMA. This is a 5-minute chart, and you see there is a strong reaction off of the 500 EMA. It comes down through it, then it reacts here and goes back down, goes above, comes back to it, has a strong reaction, then it comes back to it again and has an even stronger reaction. Let's look at the ICT entries from this chart. This whole move could be considered a breaker because price has moved past that level and then retraces. This is 50% of that breaker, and this is where that strong reaction took place. This move was a big move down. Then price came back up, crossed back over the 500 EMA, and then has a break of structure from that initial reaction and comes back down. This measures the new week opening gap, and this is 50% of that new week opening gap. Price reacted very strongly off the 500 period moving average, but if you look at it, that moving average crossed right at the 50% level of the new week opening gap. Then price came back over, and this is your retracement of 61% optimal trade entry off of this move right here, between this swing low and this swing high. And that is another entry, an OTE off of a strong reaction of a 500 EMA. So this 500 EMA and these three examples gave you confirmation of the ICT entries. As promised, here is a way to tell the daily bias by using moving averages. As we see price cross this 200 EMA on a daily chart and then continues all the way over into January, we see that there are two areas of liquidity. And this is where people can make a mistake in terms of ICT concepts. Which area of liquidity is the one price will be heading towards? But if we look at the 200 period moving average, we can see that price has continued a long direction away from the 200 period moving average. And we can use ICT's concepts where there's a break of structure and then a return back to a breaker or an order block or a fair value gap. You can find those on the smaller time frames. But in terms of the daily bias, we will see how this candle that broke the structure is 101 candles from the initial crossing of the 200 EMA. That makes the likelihood of price continuing further for another 101 candles not likely, because it has to revert back to this 200 EMA. Thus, we can guess that price will move to the 200 EMA and then possibly reverse or continue higher. And in this instance, price broke structure on the 101st candle, then retraced, and then took off to the upside. Coincidentally, the break of structure also happens at a cross of the 50 EMA. That can also give us a clue into the direction of price. We hope you've enjoyed this video. Please like and subscribe so that others may benefit from this information. Please leave a comment below if you have any questions. Thanks for watching.